Banking is one of the most profitable businesses in the world, and if you could participate in that profitability, why wouldn't you? What if you could get in on that side of the equation? John ends up 1.696 million ahead, not from buying extra equipment, not from doing more jobs, not from making high returns elsewhere, but from changing the flow of money, from financing his own purchases, maintaining control, and reclaiming the interest that would have gone to the bank. He was able to produce an additional 1.696 million. Okay, so over the course of the next 30 minutes, I want to walk through how you can run your business without the bank. That's exactly what this presentation is going to be about, how to create a system of financing and savings that puts you back in control and allows you to reap additional benefits from your business that someone else is currently profiting from. But first, I want to give a quick background on me and my firm. My name is Zeb Chapman. I've been in this business for about a year and a half now. My firm brings over 14 years of experience helping individuals and business owners take back control of their finances. We are proud practitioners of the infinite banking concept, and everything I'm going to show you today comes from what we personally do in our own lives and what we have been helping clients do over the past 14 years.
Great intro, Zeb. And let me also welcome you to our video presentation. My name is Frohn, and I'm a decade-long client of Chapman Financial that has joined Zeb and his father Scott on this mission to educate others. Jumping in, we believe there are three core issues that plague Americans financially. The first, low personal savings rates. In 2023, the average personal savings rate in the United States was just 4.1%. That means only 4.1% of disposable income in any household went towards savings, whether in a traditional savings account, a money market, brokerage account, or even just cash in a safe. That number is alarmingly low, and we're on a mission to help our clients raise it, not just for emergencies, but for long-term financial control. The second, over-reliance on banks for financing. In today's world, if you want to buy a car, you go to the bank. Need to finance equipment or get a line of credit for your business? You go to the bank. Now, that access to liquidity is helpful, but it comes at a cost. Interest payments, and a loss of control. The bank sets the terms, not you. We believe you should be in the driver's seat when it comes to accessing and using your capital. And the third point, over-reliance on tax-deferred retirement plans. We also see too many people putting the bulk of their retirement savings into tax-deferred vehicles like 401ks and IRAs. But here's the question. If you believe there is a high possibility that taxes could go up in the future, and math dictates that this is likely, wouldn't it be prudent to hedge against this? Granted, these plans do have a place. We personally have a portion of our retirement funds in tax-deferred accounts, but it should never be the majority. Relying too heavily on these accounts could leave you vulnerable to possible future increases in tax rates and give you less flexibility when you need income in retirement. We're not going to simply name these problems, though. We bring them to the surface because this presentation is about how we tackle all of these issues simultaneously, using a strategy that gives you more control, more access to capital, and a more sure and efficient financial future. So let's get started. Pictured, you will see a typical revenue stream and budget layout for an average mid to large size commercial landscaping operation. On the left side, we see $1.5 million in annual revenue. And as we follow the flow to the right, we see where that money goes. There's $525,000 allocated for labor, $300,000 for materials and supplies, another $100,000 for equipment principal payments, $37,500 in interest payments, and $40,000 set aside for depreciation of the equipment. After accounting for $80,000 in taxes, what remains is a net after-tax profit of $175,000. Now, what we're aiming to do here, and how we're going to address the three key issues mentioned previously, is straightforward. We're going to take the equipment interest payments and move them down into the net profit section of your balance sheet, as shown here. We're not trying to change your operation, we're not promising better interest rates or renegotiated terms, and we're not trying to optimize the operations of your business. What we are doing is making your financing function more efficient. That's the only lever we're pulling. This is what we've been doing successfully for the past 14 years, helping clients improve their financial outcomes without touching the core of their operation.
So to frame this properly, I want to start from the very basics. Now, none of this is going to be new to you. This is just about starting from square one and building from there. Let's take a look at traditional equipment financing and how it typically works in the real world. Here we have a John Deere 333G priced at $150,000. Standard financing calls for a 20% down payment, which comes out to $30,000. Keep in mind, part or possibly most of that down payment is likely going to be covered by a trade-in, so it's not necessarily all cash out of pocket. That leaves a financed amount of $120,000, and for the sake of this example, we're assuming a 5.5% APR over 48 months. Now, I know your current rate might be a bit higher than 5.5% given today's rate environment, but what we're trying to do here is look at this from a long-term perspective. Rates have been both higher and lower in the past, so we're going to stick with 5.5% for consistency through this presentation. So for this example, in any given year, the purchaser of this machine could look at his books and say, okay, interest on this machine only cost me $3,100 this year. Not bad. But what we want to consider is total interest paid over the life of the loan. So at 5.5% over 48 months on 120,000, you'll end up paying about 12,500 in total interest. Now, that interest is a tax write-off, which is a silver lining, but at the end of the day, that's 12,500 in profit for the bank or finance company. That's what they live on. Think about it. When you swipe your debit card or write a check, the bank doesn't charge you a fee. That's not their game. Facilitating transactions is just a convenience. They're not in business for that. Banks are in the business of lending money. And this example makes it crystal clear. 17,500 in interest is value that you created, but it went to the bank, not back into your operation. And we're not just talking about one piece of equipment. Depending on the size of your operation, you might have 4, 5, or even more equipment loans active at any given time. So it's not just 17,500 in interest here, it's another 20,000 there, 10,000 over there, and over time that interest will stack up. And yes, your business is profitable. It produces the positive cash flow to make all of this work, but if there's a way to keep more of what you earn, to reclaim some of that value, wouldn't it be worth looking into? Banking is one of the most profitable businesses in the world, and if you could participate in that profitability, why wouldn't you? What if you could get in on that side of the equation? And that's the conversation we're inviting you into today. So here's what we're going to focus on for the remainder of the presentation. We're going to move beyond the basics and start looking more closely at what we actually do here at Chapman Financial, what strategies we implement, and how those strategies can help you run a more efficient and more profitable business over time. Now, just to bring it back for a second, let's revisit the issue of interest. What we've been talking about in regards to how much interest is charged on a singular loan up to this point is just the starting point of a much larger picture. Let's look at what these loans really cost you over time. What we've done here is project those interest expenses out over the course of 35 years, basically a working lifetime of equipment purchases. We're keeping the interest rate constant at 5.5%. Yes, it will fluctuate. We've seen that already over the last few years, and no doubt it will continue to change. But for the sake of long-term planning, a 5% average is a fair baseline. Now, something else to factor in is inflation. As you know, equipment doesn't get cheaper. If anything, prices rise every year. That's why in this model, we've assumed a 2.5% annual inflation rate, not extreme, just steady, realistic growth. And over time, those increases are going to compound. So this software allows us to project that data across nearly 4 decades of business operations. At the top of the screen, you'll see some familiar equipment categories: mowers, trucks, excavators, skid steers, and box trucks. These numbers reflect the actual financed amounts, not the sticker prices, since we are factoring in a typical down payment and trade-in. Over the course of this 35-year projection, we're assuming that you'll purchase 11 wide deck mowers, each financed over 3 years, then 6 Chevy flatbeds, 6 mini excavators, 5 skid steers, 5 box trucks, each financed over 5 years. All of this is based on realistic timelines for equipment turnover in an active growing operation. And again, all of these purchases are projected to increase at a cost of 2.5% annually to account for inflation. So what's the end result? Running this operation and purchasing that necessary equipment under these assumptions at 5% interest over 35 years results in a total projected interest cost of $297,000. That's $297,000 that doesn't go towards building your business, hiring new talent, or upgrading equipment. That's just interest. So I'll pose this rhetorical question. If we could take back even a portion of that, say 10%, would that help your bottom line? What if you could keep 20%, 30%, even 40%? That's what we're targeting here. We're not trying to make your loans cheaper. We're not here to tell you to squeeze 2 or 3 extra jobs out of your crew every year. We're not even asking you to operate differently. We're simply focused on one thing: changing the direction of where your cash is going and giving you more control over the financing function in your business. So how exactly are we going to do that? Let's take a look.
To really illustrate what we're talking about here, I want to compare the balance sheets. Yours versus the bank's when you take out an equipment loan. Let's look at yours, or the business side, first. When you finance a piece of equipment, say a John Deere 333G, you acquire an asset, which is the machine itself. But at the same time, you also take on a liability, a $120,000 loan with interest. Let's say that interest is 5% on the principal. Now go over to the bank side of the ledger. Things look completely flipped. To them, that same 5% interest is not a liability, it's an asset. That's where they're earning their return. Meanwhile, the $120,000 they loan to you is their liability. They've written a check from their capital account and they no longer have direct access to that cash. But here's the key. Even though they gave up the cash, they still maintain control. They hold the title to the equipment until the loan is paid in full. So while it's sitting in your yard being used in your operation, technically, it's still theirs. And if for any reason you fall behind on your payments, say you hit a tough patch and have to miss a few months, they're going to come knocking. They'll reclaim the asset and leave you without the very tool you depend on to generate income. So what we're proposing is simple. Combine both balance sheets in a way that works to your benefit. You still acquire the asset, you still make the payments, you still have the loan balance and the interest just like before, but the difference is you own the financing mechanism. You're still putting out that 5% interest, but instead of it being profit for the bank, it becomes an asset for you. That $12,500 in total interest we talked about earlier, now instead of sending it out the door, we're working to redirect that cash flow back to you. And more importantly, you retain control. You keep the title. You don't have to mail it off to a lender and wait for it to come back in once you're fully paid off. And that means if there's a slow month, like if the weather's bad and you can't get in the field, you've got flexibility. You have the option to pause payments without the fear of losing the equipment that keeps your operation going. Because here's the bottom line. If the bank takes the machine, you lose your ability to produce. You lose your cash flow entirely. But when you control the financing, you control the equipment, and therefore your ability to generate income stays intact. And that goes back to one of the core issues we talked about earlier, America's over-reliance on banks and outside lenders. A big part of that is the fact that we've handed over control. Our goal here is simple, to return that control back to you, to help you keep more of your money and take ownership over the financial engine of your operation. Here's how we're going to make this shift happen. Right now, if you look at the current financing structure of your operation, there are three main players involved. In the center, you've got your business. Over on the left, there's the equipment dealership. And on the right, there's the local bank or lender. Here's how the money flows. Your business receives funding from the local bank in the form of a loan. You take that loan and write a check to the equipment dealer. In return, you get the equipment you need to run your operation. As you generate revenue from doing what you do best, you take a portion of that cash flow and send principal and interest payments back to the bank. Now here's the part that most folks don't think twice about, but it's critical. Once you've covered your expenses, you take what's left, your profit, and you deposit it back into the same bank or one just like it. They may pay you a little bit of interest, sure, but here's the real kicker. You're walking in the front door of the bank with your hard-earned money and making a deposit, then walking around to the back door, borrowing that same money back at a much higher rate. Because that's what banks do. They take your money, turn around, loan it to somebody else, often right back to you, and they earn the spread, or the difference in interest rates. And while the physical bank you're depositing into and borrowing from may be different, they're operating under the same system. Now here's the key idea. We're not trying to change everything about your operation. We're not telling you to stop financing equipment or restructure your whole business. We're only changing one thing, where your deposits go and where your loans come from. Instead of using the local bank, we want you to become the bank. You take full control over the financing function. You're the one making the lending decisions, and you're the one benefiting from the interest. You're the CEO, the administrator, the account holder, and the owner, all in one. And that brings us to what we're really talking about here, the infinite banking concept. Now, of course, you're thinking, starting a bank? That sounds like a massive undertaking, and you'd be right. Starting a traditional bank isn't something most business owners can realistically pursue. It typically requires $12 to $25 million in startup capital and at least a year or more to go through the regulatory approval process and secure a charter. It's long, expensive, and highly regulated, well beyond the scope of most operations. But here's the good news. You don't need to start a traditional bank to think and operate like one. And that's where the infinite banking concept comes in. It allows you to create your own private banking system, one you own, control, and benefit from, without the massive capital outlay or red tape. What we're talking about is creating a private banking system, custom built for your business, using a proven, structured financial strategy that gives you all the key benefits of a bank without the overhead, regulation, or timeline of starting a real one. So let's break down how that works and how you can put it in motion for yourself. One of the most effective ways to take control of the financing function is by using a properly structured whole life insurance contract. Now, this isn't your typical life insurance. Traditional life insurance focuses on getting the most death benefit for the least amount of premium. What we're doing is the exact opposite. We want to get the least amount of death benefit for the most efficient premium because that allows us to maximize the cash value, which is what powers your private banking system. Here's how it works. You, on the left side, fund the policy in two ways: base premium and something called paid-up additions. This money goes into a specially designed whole life policy issued by a mutual life insurance company. Now, the mutual part is critical. Unlike stock companies, mutual life insurance companies are owned by the policy holders, meaning you. That means you're not betting against the company and they're not betting against you, your financial partners. Stock companies care about returning profits to their stockholders, not the policy owners. The insurance company contributes in two additional ways. They provide a guaranteed interest rate and they pay non-guaranteed dividends based on the company's performance. So you've got cash flowing into the policy in four directions: your base premium, your paid-up additions, the guaranteed interest, and the potential dividends from the insurer. This creates a powerful compounding asset inside your policy. Once the cash value has accumulated, you can access it through policy loans. You can use these loans to purchase equipment, invest in real estate, buy a vehicle, whatever your business or personal needs are. You repay the policy loan with principal and interest at a market rate, but here's the difference. The interest you're paying is going back into your system, not a third-party lender. And when you reach retirement age, you can access the cash value tax-free through policy loans or structured withdrawals. That addresses one of the biggest financial concerns today: future tax risk. With the direction federal spending is heading and the possibility of rising tax rates in the years ahead, because of a little thing called math, it makes sense to secure a stream of tax-free income in retirement, not defer taxes into an uncertain future. That's exactly what the strategy helps you do. You're reclaiming control, building your own bank, and creating a future that's not dependent on external lenders or volatile tax policy.
So now let's take a look at the lifetime impact of implementing this strategy. This is going to be a high-level overview, just a 10,000-foot view to help illustrate how the process works over time. We're going to walk through a hypothetical example to show the potential value of employing the infinite banking concept in your operation. So let's meet our good friend John Doe. He's 40 years old, and for the purposes of this example, we're assuming he qualifies for a select rating just above standard. The insurance company sees him as a solid risk. We're also keeping our previous assumptions in place: 2.5% annual inflation and a 5.5% interest rate on all loans taken from the policy. Now let's look at the premium structure. For the first 5 years, John puts $40,000 per year into his policy. In year 6, that drops down to $16,000 per year moving forward. What's happening here is simple. His base premium is $16,000 and he's adding a paid-up additions rider of $24,000 in the early years. Together, that makes up the full $40,000 annual contribution. That overfunding in the early years is crucial. It's how you capitalize your system, how you fuel the bank, so to speak. Eventually, the policy reaches a point where the dividends are strong enough that you no longer need to overfund it, and that's when it begins to leverage itself and to continue growing with less input. Now, let's take this strategy and apply it to a real-world operational timeline. So over the next 35 years, John uses his policy to finance some of the equipment his business needs. Slowly at first, as he has to capitalize his bank, but as time passes, he's able to finance a larger share of his operation. In this example, he finances 11 wide deck mowers, 6 Chevy flatbeds, 6 mini excavators, 5 skid steers, 5 box trucks. Every piece of equipment is financed through policy loans at 5.5%, and every purchase assumes a 2.5% annual inflation rate, just like in the early example. By simply redirecting the loans he would have taken from the bank back to his own life insurance policy and repaying those loans like he would have with the bank, the result over 35 years is a net financial impact of $1.696 million. Let me repeat that. John ends up $1.696 million ahead, not from buying extra equipment, not from doing more jobs, not from making high returns elsewhere, but from changing the flow of money, From financing his own purchases, maintaining control, and reclaiming the interest that would have gone to the bank, he was able to produce an additional 1.696 million. And along the way, he gains all of the additional benefits we've talked about. He has full control of the system. There's no risk in having his equipment repossessed if things get tight. He has flexibility when he needs it. And when he reaches retirement age, he has access to that accumulated cash value tax free. This is the power of infinite banking when it's applied correctly and consistently over time. So let's talk about the why behind using whole life insurance for this strategy. You might be wondering, why not just use a checking or savings account and take on more of the financing function myself that way? Why get a life insurance policy involved at all? And that's a fair question. So here's why whole life insurance, when structured properly, is such a powerful tool in this strategy. First, it's safe. The type of life insurance company we use is a mutual life insurance company, organizations that have been around for over a century and have thrived through every kind of economic environment. In fact, mutual life insurance companies are considered to be one of the four pillars of capital in America, right alongside Wall Street, the banking system, and the federal government. Of the four, mutual life insurance companies are arguably the most stable. During the Great Depression, while many parts of the financial system were collapsing, mutual life insurers stood out for their resilience. Their conservative investment strategies and strong liquidity positions allowed them to continue operating without disruption. Second, these plans are contractually guaranteed to grow. There's a floor built into the policy. For example, let's look at year 30 of John Doe's policy. By then, he's put in 600,000 total, and his guaranteed cash value is over 729,000. That's the minimum. That value will be there no matter what the broader economy does. And remember, this is not just about the policy alone, it's about the process. The infinite banking concept is not a product, it's the system of flowing money in, flowing money out, paying interest back, and turning liabilities into assets. So, another important feature is creditor protection. In many states, the cash value of a properly structured whole life insurance contract is protected from lawsuits, judgments, and liens. If you were ever involved in a legal dispute or had a claim placed against you, the funds in your policy cannot be touched. That makes it one of the most secure financial vehicles available. Then there's the strength and history behind the mutual structure. These are organizations that think in decades, not quarters. And unlike stockholder-owned corporations, they're not chasing short-term gains to impress Wall Street. They're making long-term decisions that benefit their policyholders, not their shareholders. That kind of long-range thinking is rare in today's financial world, and it's one of the key reasons why these companies remain stable and consistent. These contracts also receive a flow of dividends. Earlier, we looked at the guaranteed column. Now look at the non-guaranteed side, where annual dividends are shown. Those dividends grow over time and represent your share in the company's profits. As a policyholder, you're part owner. If the company has a profitable year, you participate in that. And here's the kicker. If you do business with a traditional bank, that bank also pays a dividend. It just doesn't pay it to you. It pays it to its shareholders. And what we're doing here is redirecting that value so you become the one earning the dividend. In addition to all of this growth, both guaranteed and dividend based, is tax exempt. You don't receive a 1099 each year, and you won't be taxed on this accumulation if structured properly. It's not like a tax deferred retirement account that penalizes you for early withdrawals. The cash in your policy is liquid and accessible at any time with no age restrictions or government imposed timelines. And of course, it also provides a death benefit. While the focus here is on the living benefits of the policy, the death benefit still plays a significant role. It's not stagnant either. It grows over time and often outpaces inflation. For example, if John's policy starts with a $935,000 death benefit, it could grow to 1.9 million by year 30. That growth ensures that your legacy is preserved and continues to benefit your family or business. These policies can even provide long-term care benefits. If at any point you're unable to perform two of the six basic activities of daily living, the death benefit can be accessed while you're alive to help cover those care costs. And finally, one of the most valuable benefits is flexibility. When you own the financing system, you have the power to pause or shift as needed. If you hit a rough patch, say poor weather shuts down operations and revenue slows, you're not at the mercy of a third-party lender. You don't risk losing your equipment or being penalized. You're in control. And very few businesses can say they have that level of flexibility. If you fully implement this strategy, you'll give your business a level of resilience that's nearly impossible to achieve through conventional banking. It's not just about making money. It's about keeping control of the money you already earned and using it more efficiently, more safely, and more strategically. So let's keep moving forward and continue breaking down why we use whole life insurance in this strategy. Now, you might be thinking, okay, I like the concept and I want to take more control of the financing side of my business, but why does it have to be whole life insurance? Why can't I just do this with another asset class? And that's a great question. So let's walk through it. Let's start by comparing it to a more basic option, storing cash. Let's say you keep cash in a gun safe or a shoebox at home, and you fund that shoebox just like you would a life insurance policy. 40,000 a year for the first 5 years and then 16,000 per year after that for every year for a total of 35 years. Now, you're using that cash to finance equipment purchases, 11 wide deck mowers, 6 Chevy flatbeds, 6 mini excavators, 5 skid steers, and 5 box trucks. Each time you need to make a purchase, you'll pull the funds from the shoebox and you'll use it to buy the equipment. You then pay that amount back into the shoebox with 5.5% interest, just like you would if you borrowed from a bank. We're also assuming 2.5% annual inflation. So what happens? By the end of the 35-year period, if you just stored the cash and did nothing else, you have around 680,000 in that shoebox. But by simply applying the infinite banking concept, borrowing from yourself and paying yourself back with interest, you'll end up with 1.092 million. That's without any market growth or interest earnings, just disciplined repayment. Now, of course, there's a few obvious flaws here. First, a shoebox does not pay interest, so you're missing out on income that you could be earning. Secondly, what happens if your house burns down? The shoebox goes up in flames too, so you decide to use a savings account instead. In this example, let's assume the savings account earns 1.8%, which is a little bit higher than the historical average of 1.6%, just to be generous. We also factor in taxes on interest earnings at a 22% rate. You follow the same process, funding the account, financing equipment purchases, paying the loans back with 5.5% interest, and adjusting for 2.5% inflation. In this case, at the end of 35 years, you'd have 1.3 million. That's better than the shoebox and better than not practicing infinite banking at all. So if you're comparing these two options, the savings account wins. But now let's look at the same process applied to a whole life insurance policy. Same funding, 40,000 per year for 5 years, then 16,000 annually after that. Same equipment purchases, same repayment schedules, same inflation rate, but now you're doing it all through a properly structured whole life insurance contract. At the end of the same 35-year period, you'd have 1.696 million accessible tax-free. That's nearly 400,000 more than the savings account and more than 600,000 more than the shoebox strategy. But that's just the monetary benefit. And as I've already mentioned, you also gain a range of financial advantages. Whole life insurance offers safety, liquidity. It comes with contractual guarantees for long-term growth, along with creditor protection. Your cash value is backed by the strength of a mutual life insurance company that's historically stable and reliable. And on top of that, you receive annual dividends, experience tax-exempt growth inside the policy, and gain access to your funds tax-free throughout your life. It also provides a growing death benefit that adjusts with inflation over time, ensuring your legacy is protected. And if you ever need long-term care, these policies provide living benefit provisions that allow you to tap into the death benefit for care expenses. Most importantly, the system gives your business a level of flexibility that very few companies ever get to experience. Not only are you producing more money over the long term, but you're doing it in a way that strengthens your business, gives you access to capital on your terms, reduces dependence on banks and market volatility, and provides all of the additional previously mentioned benefits. That's the power of combining the infinite banking concept with whole life insurance, and that's why we use it as the financial foundation for this strategy.
All right. We've covered a lot of ground in the last 25 minutes, and Zeb and I want to take a moment to wrap this up with a quick summary. At the top of the slide, you'll see the phrase two-sided coin. You can use this analogy to envision this whole strategy and process. Right now, your business operates like a one-sided coin. Your day-to-day operations generate your income. You're running a strong business. You're covering your overhead, paying your employees, meeting your tax obligations, and handling your liabilities. But there's another side to your business that often goes untapped, and that's the financing side. Right now, someone else is making money off of that side. The banks are financing your equipment purchases. They're using your need for capital to earn interest and grow their own business. In their model, you are the asset. You're the borrower, the debt instrument that drives their returns. We want to flip that coin over and help you start profiting from the financing function of your own operation. We're not asking you to change your day-to-day operations. We're not asking you to take on more risk or more strain. What we're offering and wanting to educate you on is a way to monetize your business in a second way by adding a private banking function that you control. With this strategy, you can start financing your own equipment purchases. You can create tax-free retirement income, provide greater control and flexibility in how your operation is managed, offer your family a tax-free benefit, and even gain access to long-term care protection, all by flowing your capital through a system that you own. This isn't about replacing your current business model. It's about strengthening it. It's about reclaiming value that you're already creating and putting that value back into your business, your family, and your future.
So after walking through all of that, let me ask you, did we change anything about your operation? Did you have to work any harder? Did you have to take on more risk, like chasing a 10% return out in the market while exposing yourself to a potential 50% downturn? The answer is no. We didn't have to do any of that. All we did was take part of your business that was already in motion, the financing side, and redirected it in a way that puts you in control. So that's what we do here at Chapman Financial. If any of this sparked some interest, if it made sense, if it felt relevant to your situation, let's talk. Let's set up a time to walk through how this strategy could work for you specifically. We appreciate your time and look forward to the opportunity to help you take your business to the next level. Thank you.